So there's a lot of courses out there telling you what you need to do to start a business. But as somebody who started their own accounting practice about a year ago and has over a decade working in some of the largest entities in New Zealand as a chartered accountant, I haven't necessarily found a really good guide for a new business coming from a chartered accountant. So here is what I think you need to think about if you're starting a new business in New Zealand. And once again, this is general information purposes only. Always speak to a professional for tailored advice. And I also have another video that talks about the business structure that you can decide to have if you're a business, so you can go and follow it over here. Hi guys, I'm Michelle, Chartered Accountant and Director of Money Savvy Move, an accounting practice based in Auckland, New Zealand. As somebody who has of experience leading some of the largest annual reports across New Zealand, I've decided to create a guide for New Zealand businesses that helps them build a financial system. Because I think the difference between a successful new business and one that isn't is not really about the product or the marketing or the service that they're offering. It is actually that they are set up with a good financial system from day zero. And once again, this is general information purposes only. Always speak to a professional for tailored advice. So this is how we're going to do this webinar. I'm going to talk about the New Zealand reality for small businesses and what I think you could apply as a week one or month one of building your financial system for your business. Difference between cash flow and profit, because it's an area that kind of trips up a lot of small businesses quite a lot. And then a little bit about IRD, and obviously how to create a pretty decent one-page annual plan that you can use in your business and actually refer to all the time. And then just a little bit of things that are happening in the background that you should know as a new business owner. Obviously, we need to start with the New Zealand reality so that you actually create a business that makes sense in New Zealand. One key thing to note is that 97% of businesses in New Zealand are small, as in they only employ less than 20 people. And then that CPA Australia has recently done a survey of small businesses across the Asia Pacific region, and New Zealand didn't perform quite well. So 38% of New Zealand small businesses grew in 2025, which put us last for the second year in a row. Because other countries within the Asia Pacific region have an average growth rate of 62% in the last year. So we are lagging behind, guys. And I think the other key thing that's probably causing us to lag behind is that only 5% of us plan to innovate in 2026. And you know, for your business to thrive, you need to be innovating. You can't be stuck doing things that don't make sense anymore. So anyway, that is the New Zealand reality check at the moment for businesses. Okay, so if you're a brand new business and you have no idea where to start to have a financial system, these are the key things that you can do in your first 7 days. First one, open a dedicated business bank account. Do not mix personal and business expenses, because if you do, it gets a little bit messy. And as your accountant, if I am looking at business transaction in a personal bank account, I don't need to know what your favorite cocktail bar is, because if you are using your business bank account to do that, I need to understand why you were at that cocktail bar. So make sure you separate those two at the start. And then the second one is GST. Know your threshold and understand when you need to register for GST. And then the third one, I'm an accountant, so I absolutely love spreadsheets, but everybody else doesn't love spreadsheets. So one of the first things that you need to do is find an accounting platform that works for you, that works for your size, that works for your business, and sign up to it, because some of these platforms, such as like Xero, MYOB, QuickBooks, Henry, and whatever, they sort of like have a integration between your bank account and the reporting platform. So then from day one, you actually are knowing your numbers. And this one is my absolute favorite. Just calculate your break even. Like, how much does your business need to make to truly be worthwhile? You need to know this at the start, not when you're 1 year deep into your business. And so the first one that we're going to talk about quite deeply is GST, because I find that like so many small businesses register for GST the moment they think about starting a business. But the thing is, for you to register with GST, you actually need to be making about 60,000. You need within a 12-month period. And so if you're under that threshold, like there might be other reasons why you're signing up for GST, but really from a compliance and practicality, it might not make sense to do so. So anyway, talk to an expert about your own personal situation. But long story short, GST works in this way. You charge 15% on invoices and you claim back 15% on your expenses, assuming that you're dealing with people that are also GST registered. And then the difference is what you pay IRD. So obviously, if you've got more sales in than your costs, you're going to pay IRD. But if you've got more expenses than your sales, obviously, you're going to get a refund. And some of the myths that I often see with small businesses, particularly like independent contractors or like kind of like micro businesses, because if you've been in business for long, you kind of know how to do this stuff, is that GST is my money. It's like, no, GST is not your money, and you shouldn't be using it as working capital for your business. The best thing that you can potentially do is for every sale you make, put the 15% aside into a separate bank account that you call GST so that when GST is due, you're not scrambling. And obviously, the second one that I've talked about, you don't need to rush to register for GST. Register when it makes sense for what you're planning to do. Like if you're going to have big expenses, like at the start of your business, then it probably might make sense to register for GST because then you can claim on all those purchases that you've made. But if you're just sort of like a solo service type thing and you're not really going to purchase anything, maybe it doesn't make sense to register that soon. And also, when you do register for GST, you can file monthly, 2 monthly, or 6 monthly. Seriously, if you're a brand new business, probably 6 monthly. But if you're somebody who is not that great with putting money aside and your business is growing rapidly, then definitely 2 monthly. But once again, general advice, talk to your accountant about what makes sense for you. And the other key thing as well is that when you're starting a business, I often see all these videos on Instagram and TikTok where everybody is talking about like their revenue, the profit they've made, and etc. And you know what? Like, I think if you're in business, you need to be obsessed with cash because we are still operating in a cash based system. Like, you have to pay things using cash. Like, you could use crypto or whatever, but in New Zealand, we primarily use cash to pay for stuff. So, while your profit might look great, if your bank balance doesn't look great, you're going to be in a lot of trouble. And I kind of have this example. So this is obviously just a general example. It's not a specific client. It is just an example where with their invoice, right? So they're in their profit and loss, they would have made a sale of like 50,000, for example, and they would have made the sale in March. But the client doesn't pay them in March. However, in April, they have to pay payroll, they have to pay suppliers, they might have to pay for rent, they might have to do all these things with money that in theory doesn't exist. So while their P&L will look really good and say, yes, sales, making profit, their bank balance, on the other hand, has no money to actually pay for bills. So the owner is going to be stressed because they are technically rich on paper, but then they are pretty much actually broke. So, one of the key things that I often tell businesses about this is that you need to have a cash flow forecast that actually determines how long your business can survive paying for things when they fall due. Because when customers take time to pay you, that's going to have a detriment to your ability to actually meet your own bills. So make sure that cash flow and profit are kind of talking to each other in a way that makes sense for your business. And then the other key thing that trips up businesses quite a bit, especially new ones, is that they think that they don't have to pay tax, or that they have to raise all these expenses all the time to minimize tax or whatever. But you know what? I think the key thing with tax is that you need to have a plan. You need to know how much revenue you're projecting to make in the next sort of like 12 months, because that is what will be used to calculate the provisional tax that you need to pay towards your tax bill. If it's too low, you're going to get a penalty. If it's too high, it's technically like an interest-free loan to IRD. And also, you just don't want to be surprised when provisional tax is due. So, my key thing is that if you're in business, set a revenue target, you know, in that cash flow forecast or whatever modeling you use, calculate your anticipated tax bill. And also in that other bank account situation that I told you about, open up a tax bank account and put aside some money every single time you hit a sale, because you don't want to be guessing. And the other key thing as well to note, if you're operating as a business, is that you might be employing people. And so with KiwiSaver, which is something that employers have to contribute, is that it used to be 3%, but then recently it has gone up to 3.5%. So then obviously the cost of KiwiSaver is going to be slightly higher than it used to be. So that's something that you should anticipate when you're operating your business, and you should include it as well into your planning. And the other key one as well that I think a lot of business owners don't realize is that since 2025, there's this thing called an investment boost. So essentially, in the past, right, like if you bought a van, you had to calculate depreciation of it, and then the depreciation was the only thing that you could sort of like claim on an annual basis in your profit and loss. But now, if you buy a brand new asset, 20% of it becomes an immediate deduction in the year that it happens, as well as depreciation. So then you get sort of like a tax saving. So if you're planning on purchasing assets, think about purchasing things that are brand new, because then you can get this 20% immediate deduction. And also, another key thing to note about things that are brand new as well, right, is that they also need to be brand new to the country. So you can buy something that's second hand overseas, but it's technically brand new to New Zealand. This is also another savvy thing to include into your financial system for your business. And as somebody who works with lots of small businesses that are in different phases of their business journey, some of the key things that I particularly see in year one of new businesses is that they are mixing personal and business money. This one is so bad, because with people that do this, I need to spend a lot of time cleaning up their books to make sure that we've separated the personal and business money. So if you forget everything I say, just have personal bank account and business bank account, and your accountant will absolutely love you. And the second thing is that they're absorbing GST instead of charging it. So they will sort of bill things at $100 instead of 115, and then the business keeps $100, and $15 is actually for GST. So actually just look at what you're doing when you're thinking about, pricing and GST and etc. And then, oh my God, this one is pretty crazy, because it's linked to knowing your numbers when you start a business. And I was actually also, I fell prey to this when I started my accounting practice, is underpricing to win clients. You don't need to underprice your services in order to win clients. Like for product-based businesses, it's a bit different, because they are hit with costs quite early. So thinking about how to price their products is sort of like front and center. But for businesses that offer a service, they often underprice to win clients. Do not do this, because if you underprice too much and you can't meet that break even, it's going to ruin your business. And then the other one as well is not having a provisional tax jar. Like, you need to think about tax, you need to think about tax, you need to think about tax, and you need to put money aside for tax. And the last one, which I think is driven by all these people talking on social media about their revenue numbers and their profit numbers and etc., it's like, don't treat revenue as profit. Revenue is the number before you calculate all your expenses and etc. You need to be obsessed with being a profitable business from day one, and you need to be obsessed by being a cash heavy business from the start, because the more cash you've got in your business, the greater scope you've got to grow and invest further into your business. And so, if you are starting a brand new business, I know I've talked about all these things that you need to think about, like GST, tax, pricing, and etc. One of the key things that you need to have is a good business plan. So, obviously, like I said, I do work with startup businesses, and sometimes they will give me a gigantic business plan, like one that is 20 pages long. And you don't need a 20-page long business plan. You need a business plan that you're able to use. And in my roles before I started my accounting practice, I used to actually lead reporting in large government departments and etc. And believe it or not, some of those places actually do operate with 1-page or 2-page business plans. So if you're a small business that is making like 200,000 revenue, or under a million, you really don't need a gigantic business plan, because if entities that are leading the country can make decisions using a 1-pager, I mean, you could have learned something from that. So the key thing that I think you need to do when you're coming up with your business plan is have your revenue targets, have your key costs, come up with some tangible things you want to achieve, right? It could be like, maybe you want to be posting on socials, maybe you want to go to a market, maybe you want to acquire 20 clients a quarter, or you want to sell 1,000 units in 6 months or whatever, but have some tangible things that you really want to achieve, but only max it to 5. Because if you have so many things, you're obviously not going to be able to measure any of those. And then the next thing is have review dates in there. You can align your review dates to sort of like provisional tax dates, GST dates, or quarterly or whatever, but have some planned periods in a year that you're going to review your business plan against your actual things that are happening in your business. And one of the key things as well is always have something that you want to stop that is stopping you from achieving your goals. And always have one thing that you want to start. And those are the key things that I think you need to include in a business plan for it to be actionable and usable. Because a business plan that is just going to be saved in your G Drive is pointless. And this is a little bit more around the whole business planning aspect. Is that so? When I worked in really large organizations, like, planning would happen consistently. It wouldn't be something that just happens at tax time, at year-end time. It's something that would happen all the time. And then I think that as small businesses, we often forget to do the planning. We're so focused with the doing that we forget to take a step back, see where things are at, and see what we need to do different. So if you're a small business, this is what you could include into your financial system to make sure that whatever you are doing gets measured and gets managed. When you finish setting up your business plan, the second thing you need to do is measure it. So you need to look at your actuals versus your budgets. You need to have some sort of like a dashboard, and you need to have some decisions that you make throughout the year based off what you have planned. And when the world changes, like at the moment, the fuel prices and etc. have gone their own direction, actually go back to your plan and adjust it. And in big corporate world, this is called reforecasting. Like things that you set up in April might not make sense in bloody June. So instead of like holding yourself to account to this plan that doesn't reflect reality anymore, reforecast it. But explain why you have changed the plan. So document everything. And then in New Zealand 2026, if you're planning for the 2027 financial year, here are some of the key things that you can think about. GDP, interest rates, investment boost is live, retail and construction sectors are struggling. So, what does that mean for your business? Make sure your plan reflects this. And obviously, you might be watching this business and you might be watching this webinar and you're not really a brand new business, but you're sort of a business that is at a stage where you want to scale. Some of the stuff is still useful because I think that if you are stage one startup, you're going to be focused on the separate bank account, Xero setup, getting your GST, knowing your break even, having page one annual a one-page annual plan. If your business, you're in year 2 or year 3 or whatever, this is where you focus on really the reviewing your information, reforecasting, having a good dashboard, thinking about what payroll means, thinking about all the KiwiSaver stuff. And if you're registered as a company, also thinking about what your director duties are and how those are reflected in your financial plan. And then if you're thinking about, gigantic scaling or whatever, having a solid financial system, which you have built in startup and growing, will mean that when you do talk to board members, you've got something that you can show them. If you are thinking about, seeking additional funding, you've got things that you can show them as well. So essentially, setting up a good financial system early on is going to be amazing for your business in the long term because it means that your governance side is sorted, which becomes a competitive edge if ever you want to grow this thing to a stage where you are no longer the key operator. I've said a lot of key things today that I would like you to take from this as a new business owner or somebody thinking about starting a business in New Zealand is that you need good systems, and good systems are not spreadsheets, they're not gigantic documents, they are actually things like making sure you've got a bank account for your business, your GST registered, and second one is that tax should never be a surprise, so you need to make sure that you're planning for it. And the third one is that create a simple one-page business plan that you review on a quarterly basis, that you amend to reflect what's happening in the world. Because if you don't plan for stuff, how are you going to know how you're doing? Don't let your business year be decided by last year's tax return, because that's something that I often see happening with small businesses. Obviously, I'm a chartered accountant and this is general advice, but if you do need any additional tailored help, you can definitely get in touch with us, because some of the key things that can help you with is understand where you sit financially, your realistic annual plan, coming up with your most important KPIs, looking at your provisional tax exposure, and etc. So hope you enjoyed. Like, follow, subscribe.